Hello, scholars, and welcome back. We're going to talk about pricing, and for this example, we're going to use a semi-annual bond. So let's take a look at this question. Pricing a semi-annual pay coupon bond. Suppose that a 3-year bond has a face value of 1,000 and pays semi-annual coupons at a coupon rate of 8% per year. If the yield to maturity is 10%, then what should the bond price be? So couple things to note when you see a question like this is when it says semi-annual coupon pay, you have to be consistent with 3 elements. The first is timing. So we have to measure time in semi-annual periods. The second is risk. So if we're given annual percentage rates, which both of these are, we have to convert them into rates per period. So a rate per semi-annual period. And the last is magnitude. So the cash flow, timing, risk, and magnitude. The magnitude here being the amount of the coupon. So semi-annual bond, those are the things to watch out for, timing, and then the rates here. So first thing is to convert this yield per period from 10% annual percentage rate into a rate per period. That says it's semi-annual compounding frequency of a 10% yield. So we have to take this 10% rate and divide it by 2 to get to a rate per period, rate per semi-annual period. Next thing to do is to take for our coupon payment here, PMT, your financial calculator will call this one. Take your coupon rate times your face value divided by the periods in a year. So our coupon rate up here was given at 8%. So all we have to do is 8% of face value. Face value was given as 1,000. So 8% times 1,000 divided by 2 will come out to a cash flow of 40 per semi-annual period. Next, your financial calculator calls this variable N. A lot of times the equation will show it as T, but it's the number of periods, in this case, semi-annual periods. If we were given a 3-year bond, there's 2 semi-annual periods per year. So 3 times 2 is 6 periods. If you ever don't know whether to divide or multiply, just write out the units. 3 years times 2 semi-annual periods per year. Years will be dropped off and you're left with 6 semi-annual periods. So 3 things are consistent. Once we see that this is a semi-annual bond, the first is time. We're measuring time and periods. Next is risk. Our discount rate or our yield to maturity is a rate per period, and then the magnitude is per period as well. So we're consistent on those things. So if you see anything differ than a year, you have to be consistent in valuation on timing, risk, and magnitude. You can also solve this now with the equation first. So we'll take the annuity component and then add the face value discounted as a single cash flow. So your 40 per period, that coupon payment, this whole line, we're going to shift here. That's the payment of the annuity stream, the semi-annual coupons. The yield to maturity is your discount rate. That's the rate we're using to set equal the bond price to the future value of the face value along with the annuity stream. So that's the rate that'll set those equal. So your 5% per period is what you're going to see here and here, and your discount rate in terms of face value. So your face value was 1,000, and that's right in there. And don't forget the other piece where the 1,000 appeared was in the payment stream. So if you prefer your financial calculator, again, you still have to be consistent in terms of timing, risk, and magnitude. So time needs to be measured in semi-annual periods. So we'll put that there, semi-annual periods. Your yield to maturity needs to be a rate per period. And conventionally, it doesn't say so, but rates are always given as annual percentage rates. That's just the convention. If you remember from the discounted cash flow approach, that's a convention required by law. So that is a rate per period. That's a yield per period. And then the payment, you have to do that same equation that is just up above, but I'll write it out here. Your PMT equals your coupon rate times your face value over periods in a year. And that was just your coupon rate of 8%, spot 08 times 1,000 over 2 is 40 per period. So those three things need to be consistently adjusted for the semi-annual factor that this is a semi-annual bond. So base of 1,000, and then you're just going to compute 6N, 5IY, 40 annuity PMT payment, 1,000 base value, and then the only variable left would be the value. So compute for the present value. It shows this as an outflow. The way to think about that is if you're a bond investor, you'd have to invest this amount with the expectation of receiving inflows of positive face value 1,000 and positive income stream there of 40. Now, if you set these two negative, the payment negative and the face value negative, then the present value would have to be positive. But that just specifies to the calculator which cash flow streams go together. You'll get the same answer either way. I just like to think as an investor, what am I investing today and what do I expect to get in the future? So just try to keep those consistent. It'll really matter when you're solving for either time and the yield or payment. Then you'll really need to be careful with those. So let's clean this up a little before we move on to our next example. Finding the yield to maturity on a semi-annual pay bond. I just wanted to set this up for you so you can view the yield to maturity as an internal rate of return. So if you're trying to find the yield to maturity on a semi-annual pay coupon bond, there's two steps to this. First, you find the semi-annual IRR. That's the internal rate of return. If you remember from capital budgeting, you'll know what that is. Capital budgeting. If not, we'll get to it eventually when we talk about capital budgeting. So we can observe as bond investors the price. Maybe the dealer gives us a price, and we can observe the coupon payment, the coupon rate, and we can see the face value. So the one piece that bond investors are always worried about and focused on is that semi-annual yield to maturity. Once that's solved, they can find the yield to maturity quoted as an annual percentage rate. So the bond investor is always focused on the yield to maturity. They can observe the price, they can observe C, they can observe FV, face value, par value, they can observe time. The one piece that they're solving for is the yield, and then they're going to compare that yield to what expected return they think is a fair compensation for the risk of that bond. And we're going to talk about credit risk. It's an important risk factor that we're going to need to understand when we start thinking about yield to maturity and questioning whether this bond is offering enough yield or if it's not enough yield. And that's a bond that whether we buy or sell. So we can then, once we have the yield to maturity, we can compute for an effective annual yield. And if you remember from our chapter 6 or our discounted cash flow valuation, the effective annual yield is the yield at which a bond portfolio will actually compound. So it's the compounding rate as if the interest rate was stated for one compounding per year. And remember that was the effective annual rate, but now we're going to call it the effective annual yield. So it's one with the yield to maturity over M, where M is the number of periods in 1 year. For us, since it's a semi-annual bond, there are 2 periods per year, 2 periods per year, 2 6-month periods in a year. That's where the 2 came from. Even if the bond was a 20-year bond, that would still stay 2. All right, let's look at an example here. We have a 3-year bond, face of 1,000, pays semi-annual coupons of 40. So no need to fall for the coupon payment. It was given as a payment per 6-month period. The price is 900. What is the yield to maturity and the effective annual yield? So you'd need to use a financial calculator to do this because you're solving for this variable. I use the financial calculator because most of our students go in to get CFA or CFP, so it's nice to know how to use this. So let's set this up. To use the financial calculator, you're going to need to set your present value equal to negative 900. Again, that's the outflow you'd have to pay with the expectation of receiving face value of 1,000. I'm going to put a positive 1,000 right there, and a coupon payment of 40 as given in the question, and that's 40 per period. We're going to solve for IY. N is 3 years times 2 for 6 periods. and we're going to compute for the IY. That will be a yield or a rate per 6-month period. And remember, whether you multiply or divide, if you get confused by that, just write out the units. In this case, we're going to multiply by 2 semi-annual periods per year, and you'd be having their periods drop off, and that's just a yield per year, which we just call an APR. So I like to write that out first because it's a common mistake for students to either be inconsistent with one of these. Just remember timing, risk, and magnitude there. There's an adjustment for these. All right, so we have 900, and you can specify that as an outflow by pressing this plus minus button at the bottom. Present value, 1,000. Future value, 40 payment for the annuity, 6 for time, N, and then compute for the IY. Now, most financial professors will show you that as a distracting choice if you have a multiple choice exam, but that's just the rate per 6-month period. And conventionally, when we talk about yield to maturity, it's an annual percentage rate. So that's where this part, multiplying by 2, comes in. So multiply that by 2 equals a yield per year. That's your yield to maturity quoted as an annual percentage rate, or APR. And your financial calculator is giving you that as a percentage. So that would be your answer. Now, that is just the yield. That's not the rate it actually compounds. Remember when we talked about that, your quoted one rate times 0 today, and then over 1 year, this bond will compound, and then so it's going to compound halfway through, and then it'll compound again. So that interest will earn interest. The effective rate will be slightly higher than the annual percentage rate. So in our case, we're going to convert this back to decimal form to use it in the equation. Let's just store that number for now in case anything happens. So recall 1, it's going to be there. So that's your rate in percentage form. Divide by 1,000, and you'll get it into decimal form. Divide that by 2 to get to a rate per period. And we're dividing by 2 because this is a semi-annual bond. There's 2 semi-annual periods in a year for our case. And then we're going to combine it with 1 equals, and then we could either square it, which we could do, or just go y to the x 2 equals, and then subtract 1. That's your effective annual rate right there. 12.44% if you round to the nearest hundred. So interest rates get pretty confusing with bonds, but we just have to handle them step by step. That's the effective annual rate on this bond. There's another way we could have solved this. If we have this number as the yield is an APR, there's another way to do this, which is the number 2 button. Up above that, it says icon V, interest conversion. Just press second, interest conversion. And if you scroll through here, you see 3 variables. The first you see is the nominal rate. That would be your yield to maturity quoted it as an annual percentage rate. That's the 1207%. The effective rate, and then the compoundings per year, or payments per year. So there you can see the effective equation. If I rewrite this for the financial calculator approach, the effective would be 1 with the nominal, or the APR, over the C over Y, the power of C over Y less 1. So from here you can see there's only really 3 variables the calculator needs to, you plug in 2 and it'll solve for the missing one. Those are the 3. So in our case, we're going to have 2 compoundings per year. So press 2 and then enter. Scroll back up. Before we have effective, we have to specify the nominal rate, and that's where I'm going to recall that answer. Enter that in there. It has to be entered as a percentage form, so 12.07. I don't like to round, especially when it comes to interest rates. So we have those 2 variables. We'll scroll back up to effective and then compute that. You'll get the same exact answer. The financial calculator is just a shortcut. It's not magic. It's just math. Now, a couple things to note when you're doing bond valuation in a corporate finance course, just things I want you to remember. Interest rates are given annually. That's convention, sometimes quoted that way by law. So unless I say otherwise, every interest rate you see is going to be stated conventionally, that is, as an APR. If you have a question where I'm asking you for a rate, it is also conventional that you give me that rate quoted as an annual percentage rate. So if I ask you for a yield to maturity, you will give me yield to maturity as an APR or whoever your finance professor is. Face value of a bond is 1,000 unless stated otherwise. So if it doesn't say, just assume it's a 1,000 face. Be consistent with timing, risk, magnitude. Be consistent there with timing, risk, magnitude, right? If it says that the bond pays semi-annual, then those three things need to be adjusted periodically. Semi-annual periods, semi-annual rates, and semi-annual payments. Just be consistent. All valuation comes down to timing, risk, and magnitude of cash flows. So on your financial calculator, this can save us a lot of time, especially when we're solving for N, IY, or payment. It's nice to use the financial calculator. So just think of them not in terms of years, but think of N as periods remaining until maturity. Think of your IY as your yield to maturity or your periodic interest rate. That's your yield to maturity per period. Present value, that's the current price of the bond. Put that negative if it's provided. Payment, that's your coupon payment per period, and then FV, future value, often called face or par. Don't get tripped up. If the professor quotes this as your par value, it's not PV, it's actually still face value or future value. That's the cash flow you get at the end. So just so we're all on the same page here, I'm just going to draw this out so you can, again, visualize this valuation as timing, risk, and magnitude on a timeline. So what your financial calculator will give you, if this is time zero today, you may pay the present value of this bond with the expectation, if this is these periods, all the way up through N semi-annual periods, that would be time. And then your coupon payment, that's your fixed and finite cash flow. That's basically an annuity, right? Fixed cash flows over finite time. That's the coupon payment. And then you have your face value out here. And then we are using the IY, or the yield to maturity per period. IY per period. So that's what your financial calculator is going to give you. A couple things, like I said, to mention is you're going to pay this price. So then these cash flows, the payment would be inflows and face value would be inflow. So just be consistent with those. They have to have the same sign. The face value and the payments have to have the same sign. So again, just think of timing, risk, and magnitude consistent. The payment is per period, per period, per period, etc. And then the yield would be per period. As a 10% annual coupon and face value of 1,000, or 20 years to maturity, yield is 8%. What should the price of this bond be? This one's a little more straightforward than a semi-annual bond. It's annually given, so we can just go straight ahead and do N is 20 years. The yield to maturity, right, 20 years to maturity. 10% annual coupon. So what we need to do there is take our equation for the coupon payment. That's the coupon rate times face value over the compoundings per year, or payments in a year. Your coupon rate is 10%. So 0.10 times face value of 1,000 over 1, because it's an annual bond. That would have been 2 if it was semi-annual. That's where we got our 100 per period. Yield to maturity, no adjustment needed there. Yield to maturity was given at 8%, so that's just 8. Remember, your financial calculator knows that that's a percent. Face value is 1,000. Par value there, 1,000. The only variable we don't have is what we're computing for in price. And let me show you how to do that. So clear out of here, 20, and then N periods, 8 yield to maturity per period, 100 coupon payment, PMT, 1,000 FV, future value, and then we're going to compute for the present value. That's a premium bond, right? That's a premium bond. The market wants to earn 8%. In this case, the bond is paying 10%. So the market wants to earn an 8% return, and the bond is paying 10. That's a premium bond. That occurs anytime the coupon rate exceeds the yield to maturity. So I like to do that double check on some of these just to make sure everything is working as we expect. So coming out with a new Hogwarts movie here, new Harry Potter movie, because Voldemort levels Hogwarts and the school needs to raise money for rebuilding. You thought they were done making the Harry Potter series, but apparently not. And to my knowledge, I think we should call this new movie Harry Potter and the Sorcerer's Loan. Okay, hope you got that one. After Voldemort levels Hogwarts, the school needs to raise money for rebuilding, and they're issuing 20-year bonds at a coupon rate of 10.2 with semi-annual payments. The yield to maturity on these bonds is 9.2. What should be the current bond price? So let's take a look. I put here the three we need to be consistent with: the coupon payment, the yield to maturity, and the time. So coupon payment, so sometimes I just use this notation: PMT equals coupon rate times face value divided by payments or compoundings in a year. So that's your coupon rate of spot 102 times 1,000 over 2 because it's a semi-annual bond. So that's where that 2 comes in. 51 per period. Next is your yield to maturity per period. We're going to convert that into a yield per semi-annual period. So you just take the yield to maturity of 9.2, divide by 2. So that would be your IY, and N is 20 times 2 semi-annual periods per year. It gives you 40 periods. So on your financial calculator, what we need to do is input this. So let's start with the coupon payment. We'll put that up there. It's spot 102 times 1,000. It's a semi-annual bond, so we're going to divide that by 2, and we're going to then put that in for our PMT payment. See my cursor there, but we just did that equation there in orange. Next, we have, let's scroll back up a little so we can see it. We have our PMT payment. We have 20-year bond, but since it's a semi-annual, we're going to multiply that 20 by 2 to get 40 periods. Yield to maturity is 9.2. That's an annual percentage rate. When we divide it by 2, that's a yield per period. So I am consistent now in terms of timing. We have 40 periods. Risk, my yield to maturity per period is half of that annual percentage rate for a semi-annual bond, and magnitude of payment. The only thing we have left to type in is our face value of 1,000. So I'm going to put in 1,000 there for the future value, and then I'm going to compute for the present value. And again, another premium bond, and let's see if that makes sense. The market wants to earn the yield to maturity of 9.2. That's not enough. The coupon rate here is actually 10, so the company's paying 10 and the market only wants 9. So that is indeed a premium. So that checks out. Okay, here's one thing I want to talk about. This is an important effect when you see bond valuation. So just take a minute to pause. I'm going to minimize our financial calculator so we can just focus on this. This is the effect of time on bond prices. And premium bonds like the one we just saw, they are paying more than the market's asking for. So that, remember, the market wants to earn the yield to maturity. In a premium bond, the coupon rate is high. So in this case, what do you think our bond is earning? What do you think the yield to maturity is? Take a second to try to think about that. What is the market yield to maturity? It's not exactly given. I'll give you a hint here. At 100% of face value, when the bond sells at its face, then the coupon rate matches the yield. So in this case, the yield to maturity is 5%. So anywhere up here, when the company's payment, the coupon rate exceeds the yield to maturity, it exceeds 5. So 10 is more than 5. 10% is greater than 5%. That's a premium bond. So what happens over time? Well, this negative effect on price occurs. As time goes on, as years go on, and we get closer and closer to maturity, if this is maturity, the bond will lose value over time. So it'll have a negative capital gains yield, which is a capital loss every year. So the bond, if the yield to maturity does not actually change when you buy this bond, you'll lose money. That present value of the bond will decrease every year. Hence the sawtooth pattern. What's going to happen with the sawtooth pattern is as time goes on, every year, that bond will slightly increase in value because its coupon payment is getting closer and closer and closer. But then as soon as the coupon payment occurs, the bond will fall in value by the amount of the coupon payment. And every time it'll fall a little bit more because of this overall pull to par effect. That bond will eventually be worth face value, right? When it makes that last payment, it'll be worth par. Now, on the other hand, zeros, or when the bond pays no coupon payment, the coupon rate is less than the yield to maturity. The bond is 100% of its value is determined with a zero coupon on the face value. And as that face value approaches, it gets closer and closer and closer. As we move in this direction, that bond becomes more and more valuable because think of it, that 1,000 face value is getting closer and closer and closer. And as we get closer to it, it becomes more valuable. So as time decreases to get that cash flow, it becomes more valuable. That's the pull to par effect. So discount bonds increase in value over time because their coupon rate is less than the rate the market wants to earn. The coupon rate is less than the yield that is. In order to compensate the investor for the yield, because they want to earn that, they have to expect a capital gain over time. Remember, there's two ways to make money in finance, and that is it pays you over time. This financial asset will pay you over time. With a stock, we call that a dividend. With a bond, we call that a coupon payment, or it goes up in value over time. So if the cash flow payment is not enough, that yield is not enough, we have to expect a capital gain yield over time to make up for the difference. Because again, the yield to maturity in this case is 5%. And I know that because bonds that sell at face value or sell for 100% of face value have a yield to maturity that matches the coupon rate. And then that's given right here. So this bond sells at par value. The reason it's going up is, again, as that coupon payment becomes closer and closer and closer to its date, it increases in value. And then as soon as it pays that coupon, that financial asset is now paying you less. So it'll drop in value back down to face. That's why it looks like that sawtooth. And the height is lower. Each of these heights are lower than the one above it because it pays a lower amount. This is paying a 10% coupon up here, whereas the par value bond is only paying 5%. Pretty neat effect there, if you ask me. It's the pull to par effect. But yield to maturity changes over time. And like when I think of bonds, where as opposed to stocks, I always think of bonds with the yield is changing, right? And then the price will change. But the yield to maturity is changing rather than the price. When I think of stocks, I like to think of the value or the intrinsic value is changing. But with bonds, it's all about the yield changing. So take a look. Let's see if we can see the relationship between bond prices and yields from these figures. So we have this overall effect of this pull to par effect. The bond is selling at a discount, right? So this is a discount bond. And overall, the yield initially starts to increase. As the yield increases, the bond price decreases. And then we have this big effect here, again, that the yield now decreases for these years, and we see the bond increase in value over that time. So I'm just going to draw this so we can see the effect of price from these yield changes. And then as the yield goes up, the bond price goes down. Overall, this overall trend is due to the pull to par effect. The fact that this bond, right, you could see up above, this bond is selling initially, we'd expect at 25%. So maybe this is their zero coupon bond right there. So one thing I want you to remember, and this is something my finance professor drew for us, is if the yield to maturity increases, then valuation decreases. So the bond value drops. And does that hold true? Is that the relationship we see here? Again, so yield to maturity here is increasing, and we see the bond falling in value. When the yield to maturity decreases, the bond increases in value. So yes, that does hold true to this graph. But you have to kind of take those in slices because you're fighting this overall pull to par effect. This bond becomes more valuable as maturity gets closer and closer. The bond becomes more valuable. All right, be careful with these. These are common little tricks that happen in corporate finance. A coupon rate. LBJ Corporation has a bond on the market with 13 years to maturity. A yield to maturity of 9.6%. Again, that's an annual percentage rate, and a current price of 1246.50. The bonds make semi-annual payments, and that's important. What must the coupon rate be on these bonds? So let's set up our variables here. We have time, we have yield to maturity, we have present value, we have payment, and we have face value or future value. So N on a semi-annual bond, if we're giving 13 years, then N is 13 times 2 for 26 periods. And I like to write out the units just as a double check that these are consistent. A yield to maturity, that's 9.6%. Divided by 2 is a rate or a yield per period then. Price of this bond, I'm going to specify that as a negative. If you ever get error 5 on your financial calculator, the reason error 5 occurs on a financial calculator is that one variable needs to be negative. And in this case, we're going to pay the price of this bond with the expectation of receiving a positive coupon payment and a positive face value. So face value on this bond is 1,000. And we're solving for the coupon payment per period. That's a cash flow per period. So what's going to happen next is once we do this for step 1, we have the amount per period. We're going to put that in this equation that we saw before. The coupon payment equals the coupon rate times the face value divided by the periods in a year or compoundings in a year. So we have 26 periods, 26 for N, 9.6 over 2 for a yield per period, and then 1246.5 negative. That's the price. Present value, you have to pay that price with the expectation of receiving the positive coupon payment, and we're going to input a positive future value. So we're going to compute for the payment. That comes out positive. Yes, that's true. So this will be our 64.80, but I'm not going to round that, so I'm just going to put it here, 64.80 equals your coupon rate. That's what we're solving for, times face value of 1,000 over 2 periods in a year. So just do some cross multiplying here. 64.80, that's multiply both sides by 2. Then you'd have 1,000 times your coupon rate, or coupon rate times 1,000. Just put it there for you. Coupon rate times 1,000. Then you divide both sides by 1,000. So it would look like 64.80 times 2 divided by 1,000 equals your coupon rate. So just don't forget your order of operations there. Times 2 equals, that's the annual amount of the coupon divided by 1,000 face value equals your coupon rate at 12.96% coupon rate. Common mistakes with bond questions are incorrectly adjusting for the semi-annual periods. Again, that has to occur on timing, on risk, and on magnitude. So where did that occur? In time, you had to multiply time by 2 to get to number of periods. You had to convert the annual percentage rate into a rate per period, and then you had to adjust the coupon rate on an annual basis, which you did by taking your semi-annual coupon payment of 64, cross-multiplying that, or multiplying it by 2 to get to the annual rate, and now your coupon rate is specified as an annual percentage rate, or an APR, so 12.96. Oh, I hope you don't help Darth Vader do this one. Darth Vader issued 5-year bonds a year ago at a coupon rate of 8.5 in order to build a Death Star. So Darth is not going to win Father of the Year, it looks like. The bonds make semi-annual payments. If the yield to maturity on these bonds is 11, what is the current bond price? Tricky, tricky. Semi-annual, that's a key factor here. I'm going to put it in red. So if the yield to maturity, it's my IY, my yield to maturity is 11/2 rate per period. We have a coupon payment of, again, I'm going to just write this equation, coupon rate times face value over compoundings in a year. Your coupon rate is spot 0.85 times 1,000 over 2 is now your payment per period. And time is the next one we're going to have to worry about. Let's pause that for a second. And then you have price, present value, and face value. It's not given, so we're going to assume face value is 1,000. Remember that. Bond, what is the current bond price? That's what we're solving for. Now, here's where the mistake occurs in this question. Time. Darth Vader issued 5-year bonds a year ago. A year ago is 4. So there's 4 years left to maturity times 2 because these bonds were initially 5-year bonds. That's 1 year ago. That means we have 4 years left of cash flow times 2 semi-annual periods in a year gives you 8 periods remaining. Oh, Darth Vader, you tricky one. Haha. That's going to trip up quite a few people. All right, let's do our evaluation. 11/2 equals your IY, your yield per period. We have our coupon rate of 8.5% times our face value. Divide that by 2 to get to a coupon payment per period. That's your PMT. And then you have 8 periods. Again, that's where a lot of the tricks are going to happen for this question. Your face value, your future value is 1,000. So I entered payment in as positive, future value in as positive, so our present value should come out negative. So we're going to compute present value, and that's a discount bond, 920.82. So that is 920.82. And the issue with this one, the common be careful, right? All of these I said be careful. Be careful. The issue here was a year ago. That's a tricky, tricky one. All right, Bateman Bank bear an 8% coupon payable semi-annually. The bonds mature in 11 years, have face of 1,000. Currently, the bonds sell for 952. What is the yield to maturity? Okay, let's take a look here. We have our payment, PMT, that's our coupon rate, times our face value over the compoundings in a year. So our coupon rate is 8%, spot 0.8 times 1,000 over 2 for 40. That's $1 per period. Be consistent there. We're going to have to be careful with our yield to maturity because this is going to come out as a rate per period. And we're going to have to multiply that answer. So I'm going to just write that in right now, times 2 periods per year. And that's because we're going from a semi-annual rate into an annual percentage rate. Right? And so then when you multiply those 2 periods will drop off from the numerator and denominator, and you'll be left with an annual percentage rate or a rate per year. That would be your yield to maturity as an annual percentage rate or yield to maturity as an APR. So let's fill out the rest. Our face value was 1,000. Our price, what it's selling for, our present value is negative 952. And time is 11 years. 11 years times 2 periods per year is 22 periods. So let me just double check that we have made adjustments for timing, risk, and magnitude. We have a semi-annual payment. We will multiply our yield to maturity answer by 2, and we have correctly accounted for time there. So just to avoid any common mistakes, I like to write it out like this. So 40 for your payment, 1,000 as your future value, 952 negative as your present value, and 22 N periods. And that will compute for your IY. That may be shown as a multiple choice if your professor does that kind of thing. That's your yield to maturity as a semi-annual rate. So you need to multiply that by 2 to get into an annual percentage rate. That's just convention to give rates annually to express the yield to maturity as an annual percentage rate. That's 869% as an annual percentage rate. So I'm going to circle that. So just be careful. Again, if you ever get error 5 on any of these questions when you're solving for yield or for payment or for time, the issue there is error 5 occurs. Probably the fix is to set present value negative and then just keep everything else the same. So I hope you enjoyed those. Let's talk a little bit about credit risk. So risk-free, before we get to credit risk, is U.S. Treasury securities. We believe these are to be risk-free because there's no chance the government will fail to pay the interest. So whether you agree with that or not, it's the closest proxy we have of an asset that we consider risk-free. So if you hear anyone say a risk-free interest rate, the thing we use is a U.S. Treasury security. So if something's not risk-free, we say there's some risk. So credit risk. Credit risk is the risk of default by the issuer of any bond that's not default free. It's an indication that the bond's cash flows are not known with complete certainty. So think of credit risk as a risk of default. We expect certain cash flows, but those cash flows we end up getting are not exactly known. They may not pay back. They may default, so they may not pay the full amount we get. So what is credit spread? Well, credit spread is the additional compensation you give to the investor for bearing the risk of the fact that it may not pay back. It may default. So let's take a look. In this case, we have interest rates given, so these are yield to maturities, and there's no credit spread here. Why? Well, that's a treasury note. That's what I was mentioning up here. That's a risk. We consider this a risk-free asset, or at least a proxy or a reliable estimate of something that has no risk. There's no credit spread. There's no additional compensation on this for bearing any credit risk because it's said to have no credit risk. It will pay back. So Johnson & Johnson has very, very low credit risk. Look at that credit spread. That's 16 bips, 16 basis points. So if you see 0.16%, that's 16 bips, BPS, basis points. So a bip is just 0.01%. It's a hundredth of a percent. So McDonald's has more credit spread, 114 bips, and Gap, I'm sure their credit spread is much higher than this now, but at the time this was made, the total yield to maturity was for 85%, and you have the risk-free rate built in there at 170%, and I got that from here. And then the credit spread is the difference of those two, plus the 315%. So what interest rate, what equation is not shown in this chart? Well, you have your interest rate. Let's put that in there as our yield to maturity is equal to a risk-free rate as our risk-free rate or risk-free rate with our credit spread. So for the last example there, our total yield to maturity was 485 bips, and 170 bips, or 1.70% of it, was the U.S. Treasury. That's just the compensation for the investor for being patient. They have to wait for their money. You have to owe them something for that. And credit spread. The fact that the bond may not pay back, you're getting an extra 315 bips just for the fact that, hey, we're going to return a little bit more because it's riskier. So anytime you ask an investor to take on risk, you have to reward them with expected return. And it's not guaranteed return, it's an expected return. So this will increase the total yield to maturity. All right, so how does the credit risk of default affect bond prices and yields? And these are some important relationships, so I checked them off for you. Let's read them together. Investors will pay less for bonds with more credit risk. And the way to think of that is you have to offer a higher return or higher expected return for bonds with more risk. That means they pay less for a bond with risk. That's synonymous. So paying a lower price means it has a higher expected return. So the yield to maturity of bonds with more credit risk will be higher, right? That's compensation to the investor for bearing credit risk. The yield to maturity on GAAP is higher than the yield to maturity on Johnson and Johnson. It's because it's a riskier bond. It has a higher chance of credit risk or risk of default, you could think. The yield to maturity of a defaultable bond is not equal to the expected return of investing in the bond. And that's an important piece. These cash flows aren't guaranteed. When they specify a coupon rate, they may not end up paying it back. It may default. So the promised cash flows from that bond, which we call coupons and face value, the promised cash flows are always higher than the expected cash flows. So the reason is some of these bonds will default. And the bond's not going to pay any more than it specifies what it will. There is a chance it pays less, and that occurs because there are some bonds that will default. So a higher yield to maturity doesn't necessarily imply that a bond's expected return is higher. So these are very important things to think about. A couple things to think about when it comes to credit analysis. This is probably helpful to you is the 4 C's of credit analysis. So again, we're going to go up here, just show you again that credit risk is the risk of default. So it's an indication that the bond's cash flows are not known with certainty. So how can we think of it? Well, here's the 4 C's of credit analysis. 4 things. The first is capacity. That's the ability of the borrower to make the payments on time. Remember from chapter 3 when we looked at interest rates, think of this as interest coverage ratio or EBIT over interest. How many times can they make their interest payment? Do they have cash on hand, or are they getting cash flow that's in excess of what they'll have to pay? So do they have the ability to make the payments on time? Next is collateral. Is there anything securing it? Is it a secured asset? Does it refers to the quality and the value of the assets that support the indebtedness? Covenants, these are the terms and condition of the lending agreements. If those are favorable, that's a good thing. That'll have a lower yield to maturity. Character, this is the quality of management in the company. So one way I like to evaluate that is just to see, does this company issue debt? Have they paid it back before? Do they do what they say? If they've issued debt, do they pay it on time? How has that gone? The character of the company. So let's look at now credit ratings. There's a few credit rating agencies here, Moody's, S&P, and Fitch. So these are considered investment grade. The first ones, they include AAA bonds, AA's, A's, BAA, 1, BAA2, BAA3 for Moody's, or BBB plus, BBB minus. Those are all considered investment grade. Non-investment grade, or what I call high yield bonds, are speculative. These are much lower grade. They have a lower credit rating. You could think of this maybe as grades in school to help you remember. A's are really, really high quality. Then you have maybe that's like A plus. This is kind of A. This is A minus, and then you go to B plus, etc., all the way down to D for default. That's very, very unlikely to pay back. But I remember being in a CFA meeting with Howard Marks, and he's the one I'm in the photo with at the top of this note packet. But he said, if you get a chance to buy a bond, there's only maybe one thing you should think of. You can only ask one question. And he related this to his car. He said, you don't know what my car is. You don't know how many miles it has. But if I gave you one question that you are allowed to ask me before you decided on whether you bought my car or not, he said there's only one question that matters. It's not what car it is. It's not what mileage it is. It's how much. Because he said at some point, if it's cheap enough, just buy it. Right? Because if it's cheap enough, there's going to be a higher expected return. And that always stuck with me. That eventually, rethinking what I think of risk is from risk in terms of expected return into risk in terms of risk comes from paying high prices. So I never think of these bonds down here as junk bonds. I don't really like that word. These could be phenomenal investments. They could offer you more return than the risk of those bonds. They could be wonderful investments. It could be high yield investments. It just means you have to do your homework. It's not, they're not junk. They're not something to be avoided. They're all of these. If all of your bond portfolio managers are stuck buying triple A's, that's going to drive their prices high and their yields too low. If people are ignoring some of these opportunities, their prices are going to be too low and their yields, or their expected returns could be really, really, really profitable investment opportunities. So I like to think there might be a lot of treasure hunting in here. I'm not an investor. I'm not a bond investor. I'm a teacher, but I like to think there could be some jewels, some treasure, something hidden in here, and a lot of reward for knowing what you're doing in there. So think of it rather as high yield rather than just junk. Some of it might be junk, but there could be some treasures in there. I define that here for you. I took this from CFA level one because I love the visual on it. And if you want me to, I can post these. Oh, I love playing around with this, and I want to show you a relationship here. Notice the relationship between credit ratings and yield. So in the first bucket I have here in red, these are AAA. So AAA yields here. Look at those percents are much lower than yields increased, and then we did this. Look at triple C's here. This is a basket of triple C high yields. This is the Fred database you can use. So what happened here, 2020, I think we all know is COVID. Look at the yields on these just skyrocket. So what was happening here? Look at this. The yields were increasing, so people were risk off. People are risk off. If they're selling bonds, the yields are going to drive up, the prices will be driven low. So there's different ways to think of this. If interest rates are low, the spreads will narrow. We call this the quest for yield. Uh, the yield on your 10-year treasury is known as your bellwether. So if anyone asks you about a bellwether rate, that's just an economic indicator for, how's the economy doing. So if this rate increases, then valuation typically falls. We see, negative things happening. So that's your bellwether. And I put that in the graph here in purple. That is the lowest of all of these. That's your U.S. Treasury security, your 10-year bellwether. It's much lower yield than any of the other baskets here. That first one was AAA in red, basket of AAA. The one I've highlighted there in blue was triple C. That has a higher yield, right? More credit risk than your AAA. So in order to entice people to buy that, you have to offer a higher yield, right? Maybe think of that as your higher expected return as compensation for bearing more risk. The lowest risk one on here, of course, is your treasury, and this is your 10-year on this. It's fun to play with these and overlay what you see with the news. I often thought it'd be interesting to ask students to buy, instead of a textbook, to ask them to buy an index fund or an index fund on equities and an index fund on bonds. Just because when you have skin in the game, it's a lot easier to learn something. So what was special about these companies when I posted this? These companies both had AAA ratings. I think that's kind of cool. Sure, you've heard of Johnson and Johnson and Microsoft. If you have not watched The Big Short, I love this movie. It's a phenomenal finance movie. Along with the DVD was this Big Short Explained. Really, really interesting stuff. It ties along everything we're working on in here. And this was eye-opening too in The Big Short. I had a lot of fun with that. I was just laughing during that scene. I thought the directors did a brilliant scene. Uh, so I hope you look forward to that. If you have not watched The Big Short, please watch it. It's a really, really phenomenal piece of work. So Treasury yield curve, let's talk about this, or just the yield curve. It's just a plot of the yields on Treasury notes and bonds relative to their maturity. So here's a couple things to think about that could impact the shape of the yield curve. It reflects the term structure of interest rates. So what determines the shape of the Treasury yield curve? Three things: the real rate of interest, the expected inflation, and interest rate risk. So are the term structure of interest rates and the treasury curve, the yield thing, they're almost the same thing, but they're not quite. The term structure is based on a pure discount bond. Treasury yield curve is based on coupon bond yield. So we say in a normal environment, that this should be upward sloping. So the yield should be higher, uh, positively sloped over maturity. So it's 30 years out here, 1 month out here, and you've got your 1 year, 5 year, 10 years in there too. So typically inverted yield curve, people panic a lot on something like that. I'll be completely honest with you. I thought I understood the reason why until I think it was Ray Dalio. It may have been Howard Marks who said that they've talked about it. And, I'm not so sure I'm sold on any one explanation for why an inverted yield curve may be predictive of anything. But something interesting to think about, something to keep in mind, especially as you work in a fixed income course, is to tease out, can you really understand the reason why, or are you just using evidence that has happened in the past to make a justification for what will happen in the future? So I think it's a little trickier than we assume just by reading a textbook to actually think through some of those things. So a couple of treasury notes, few highlights. They're free of default risk. We call them default free. They're taxable. They're highly liquid. It's not true of all bonds. There are some additional factors to think about. So let's look at those, these definitions. Uh, before I talk about more determinants of yields, I want to talk a little bit about the Fisher effect. So your nominal rate, your real rate, and your Fisher effect. The Fisher effect just specifies the relationship between nominal returns, real returns, and inflation. So your nominal rate, these are rates that are not adjusted for inflation. It's the rate your money grows. This is the rate at which your money will grow if invested for a certain period. The real rate is the interest rate or rates of return that have been adjusted for inflation. Think of this as your growth rate of purchasing power. So the growth rate of purchasing power is one with the real rate equals to one with the nominal rate over one with the inflation rate. So your growth rate in purchasing power is the growth rate of money over the growth of prices. You can approximate this as the real or the nominal rate is approximately the real rate plus inflation. However, don't use this approximation to actually do any math, any compounding of it, because any differential, any estimate you make in an interest rate compounded is just going to be magnitude off. And I'll show you that future value equals present value times 1 with R to the T. T is exponential. So if there's some kind of estimate in here, you said it should be 3 as an estimate, and it was really 3.25%. That's going to have a massive effect over something like 50 years. So be careful using these approximations or estimations when it actually comes to compounding. It's really going to get you in trouble. But just thinking back of the envelope or helping you think through a mental model, think through a problem, it can be used. But just I would limit this in a world where there's so much uncertainty. We should at least be certain in our math. No need to introduce any more uncertainty than there already is in financial markets. So just be careful with approximations. You could tell I'm not a huge fan. So does it matter whether what we're using here? Well, it does. You discount nominal cash flows at nominal rates. You discount real cash flows at real rates. So anytime you're doing that valuation, whether it be present value or future value, and I'll just put those equations there for single cash flows, just be consistent. Just be consistent. Nominal. If the cash flows are nominal, then discount at nominal rates. If they're real cash flows, discount at real rates. So don't mix them. Either approach will get you the same answer. These are just different determinants of buying yields. We talked a lot about yields, and you saw in some of those examples I had different yields. So what determines those? Well, there's a few factors. The real rate of interest, the inflation premium, the interest rate risk premium, the default risk premium, the taxability premium, and the liquidity premium. The way I think of all these is kind of like an a la carte menu. You go out and you order different sushi rolls or whatever. The more you order, the more it gets tacked onto your bill. But think of this, if there's real rate of interest and maybe that's a 2% right there. Inflation premium. This is the portion of the nominal interest rate that represents compensation for expected future inflation. If you're buying a fixed income security and you expect inflation, well, your coupon payment of 50 on a bond, that 50 purchases less and less over time. So maybe you demand more yield to maturity from that. So add on another 1% there. If there's interest rate risk premium, and this represents compensation investors demand for bearing interest rate risk, you may add on another 50 bips right there. Default risk premium. If this bond has a likelihood of not paying back, then you may have to add some more. Could be 5%. I don't know, maybe 3%, but you're adding 3% for the default risk premium. Can you see how this bond is now more and more becoming higher risk, right? And it's all these premiums we're adding onto it. If the bond is not tax favorably for the investor, maybe it adds more to the yield. Liquidity, if the bondholder is stuck with this bond and they don't have the option of unloading it, you may have to pay another premium. Maybe that's 75 bips. It all depends on the bond, but think of these as different ways to think about what could the total bond yield be. Just dissect it into all these little pieces, right? The real rate of interest, the inflation premium, the interest rate risk premium, the default risk premium, taxability premium, and liquidity premium. So I know when we work through some of these examples, I just give you certain numbers of, well, in this case, the bonds yield is 10%. Where did I come up with that? Well, I came up on it from all of these different elements. All of these things can contribute to bond yields. Each bond is different. You really have to do your homework and open up to which one of these are relevant, especially when you get into default risk premium. Any one issuer could have a number of different bonds outstanding. So the same issuer may have bonds of different yields. And it's because some of these factors are different, and that's okay. These are all the different determinants that could impact a bond's yield. Take a look at this. I always love this one. The best thing about Captain Steroid comic books is that every issue is number one. Every issue? Sure. That way they're all collector items. These will be worth billions of dollars someday. Of course, they're so cheaply printed you have to preserve them in plastic bags, but it's a small investment for such a huge guaranteed return. Gosh, I keep buying bonds. Look at the great committee that drew this issue. And the reason I love this is we never say such a huge guaranteed return. There's no such thing as guaranteed returns, but that always made me laugh. If you ever want to try these out, FINRA Markets has a great little bond center here. You can look at all these different things and really get trapped into here, just thinking through different bonds and trying to treasure hunt here. You're welcome to do so. Now, I want to make one more comment here before we close, and that's value versus price. I know in many textbooks, we consider them synonymous, that the price is the value of the bond. But I want to be really careful in making that. And let's remind you of this quote that Warren Buffett said, there are only two variables you have to plug in to value any financial asset. That's simply the stream of cash in and out between now and Judgment Day and discounted at the proper rate of interest. So how does that relate to a bond? Well, the bond is the financial asset. The stream of cash in for the investor is the coupon and the face value. The price is the cash flow out between now and Judgment Day, and Judgment Day is term or maturity, discounted at the proper rate of interest, the yield to maturity. So what does this mean? Well, remember this other quote by Warren Buffett. We've all heard it. Price is what you pay, but value is what you get. Price and value are not the same thing. Price does not equal value. I believe that long term, prices and value should converge, which means that markets are efficient enough that if you've made a good decision, then it should pay out long term. It's not necessarily every nanosecond that prices should equal value, but if you're making good decisions over time, you'll be rewarded for that. Sometimes probabilities work against you, right? But you can have good decisions that have bad outcomes. But just remember, price is what you pay and value is what you get. So how does that relate to this formula for bond valuation? It may seem like we're splitting hairs, price and value, whatever, but think of it this way. I'm going to zoom in just so I can make sure you see this. So the yield is the discount rate that sets the present value of the promised bond payments equal to the current market price of the bond. So remember, we can observe the bond price, we can observe the coupon rate that will determine the coupon payment, and we can observe face value, and we can observe time. So the yield to maturity is that rate that sets this equality right there. So if the bond's yield is too high based on your analysis or your determinant of what the bond yield should be, the bond could be undervalued. That'd be a bond you'd want to buy. If the bond's yield is too low based on your analysis, the bond could be overvalued. You'd want to walk away or even sell that bond. If you assume value equals price, then you make the assumption that markets are always efficient. And for anyone in finance, it's a very dangerous assumption. For most people, it's okay to assume that in the long run, on average, markets are efficient and you'll be rewarded for that. But if you're actually trying to get treasure hunting, if you're actually looking into things to try to earn a disproportionate return or alpha or anything like that, you really have to make your analysis and be very careful about it. But I would argue against efficient markets. To say that they're always efficient, I don't think that's fair. I think there's enough inefficiencies that there could be a payout for those that are really doing good analysis or have some kind of unique advantage. But to assume that you're smarter than someone else is a really unfair advantage. It's not really true. I think you either have to, work harder, read more, be more patient, or think differently, or think, as Howard Marks says, on a second order basis or second level thinking. There has to be some reason that you're right and the market isn't. So you have to be different or think different or act different or analyze differently to get a different return and really try to uncover the source of that. If you can't consistently uncover the source for your beating the market, it's probably just luck. So again, just think of it this way. When it comes down to price and value, they're different things. If the bond's yield is too high, based on what you think, the bond is undervalued. The market is discounting it too much. The bond price is low. If you're buying things at a low price, then you could have a high expected return. However, if the bond's yield is too low, the bond could be overvalued. So be very careful in thinking about these. I know sometimes we just get in the habit of asking what's on the test. Is this question on the test or is that question on the test? But step back and try to make sense of this. This is really what's going to separate financial analysts that are good at their job and those that are really going to turn out to be great portfolio managers. So thanks a lot. I know this was a little bit longer of a session, but I enjoyed sharing bond valuation with you.